The US stock market has been on a real roller coaster lately, with wild swings that have left investors and analysts alike on edge. Every day seems to bring a new headline, a new surprise, and a new reason for the market to jump or tumble. Investors are scrambling to process a flood of news from Washington and the economy. From breaking policy announcements to unexpected economic data, the sheer volume of information can be overwhelming, making it tough to know what really matters. One day, the market drops. The next, it bounces back. These sharp moves can happen in a matter of hours, and sometimes even minutes, as traders react to every twist and turn in the news cycle. Last week, stocks fell for 3 days straight after President Trump announced new trade tariffs, taxes on imported goods that can drive up prices. The announcement sent shockwaves through the market, as investors worried about the impact on global trade and company profits. But by Friday, the Dow, S&P 500, and Nasdaq all finished higher, showing just how jumpy the market is. It was a dramatic turnaround, fueled by a sudden shift in sentiment and a wave of buying from investors who saw opportunity in the chaos. What changed? A new inflation report showed prices weren't rising as fast as feared, calming investors. Lower inflation means the cost of living isn't climbing as quickly, and it can also mean the Federal Reserve is less likely to raise interest rates soon. This back and forth is called market volatility, prices swinging quickly and unpredictably. Volatility can be unsettling, but it's a normal part of investing, especially when big news is breaking. For anyone with a 401k or investment account, it can be nerve-wracking. Watching your savings rise and fall in real time can make it tempting to react emotionally, but that's often when mistakes happen. The market often overreacts to short-term news, but the real story is in the details: tariffs, inflation, and what economic leaders are saying. It's important to look past the headlines and dig into the facts before making any big decisions. Understanding these moving parts is key to making sense of what might happen next. By following the data and keeping an eye on long-term trends, investors can avoid getting swept up in the daily drama. The market's mood can shift in a heartbeat, but it's driven by a mix of fear and optimism. Sometimes, all it takes is a single report or a comment from a leader to send stocks soaring or sinking. Staying focused on the bigger picture helps investors avoid getting caught up in the daily noise. History shows that markets have always had ups and downs, but patience and perspective are powerful tools for long-term success. The week's wild ride is a reminder: in investing, change is the only constant. By staying informed and keeping your cool, you can ride out the bumps and stay on track toward your financial goals. On September 25th, the Trump administration announced new trade tariffs targeting specific industries. The biggest, a 100% tariff on branded and patented pharmaceuticals, doubling the cost of many imported medicines overnight. Drug makers building new U.S. plants are exempt, an incentive to boost American manufacturing. Heavy trucks now face a 25% tariff, hitting transportation and logistics companies. Home goods weren't spared. 50% tariffs on kitchen and bathroom fittings, 30% on upholstered furniture. These moves are part of a year-long push to pressure global companies to invest in the U.S. For consumers, it means higher prices on everything from sofas to prescription drugs. Businesses must decide, absorb the costs or pass them on to customers. Each new round of tariffs forces companies to rethink their strategies in a rapidly changing landscape. The balancing act between profit and price just got a lot tougher. The new tariffs have put major U.S. companies in a difficult position, especially those in the pharmaceutical sector, which relies heavily on global supply chains for both raw materials and finished products. Suddenly, the cost of doing business has changed overnight, and companies are being forced to rethink their strategies. Giants like Johnson & Johnson and Pfizer saw their stocks wobble as investors weighed the impact of doubled import costs. These companies are now under pressure to explain to shareholders how they'll manage higher expenses without sacrificing innovation or patient access to medicines. The exemption for US-based manufacturing is pushing these companies to speed up expansion plans. But building new plants takes years and requires massive investment. In the meantime, they must juggle rising costs and potential supply shortages, all while trying to stay competitive in a global market. Truck makers like PACCAR and Daimler Truck now face tough choices: raise prices for customers, absorb the costs themselves, or risk shrinking profits. Each option comes with its own set of risks, and none are easy. Home goods brands like Kohler and La-Z-Boy must navigate steep new tariffs on their imports. For these companies, the challenge is not just about higher prices, but also about maintaining quality and keeping shelves stocked as supply chains are disrupted. The ripple effect hits thousands of smaller suppliers, many with little room to absorb higher costs. For small businesses, even a modest increase in expenses can threaten their survival, forcing them to make tough decisions about staffing, pricing, and sourcing. Across industries, companies are scrambling to adapt, rework supply chains, and protect their bottom lines. Some are seeking new suppliers, while others are renegotiating contracts or investing in automation to cut costs. The pressure is on to localize production or risk losing market share to competitors who can adapt more quickly. For many, this means a fundamental shift in how and where they do business. For many, the path forward is uncertain and expensive. The choices companies make now will shape their futures for years to come, and not all will survive the transition. The tariff shock is forcing a massive recalculation for businesses big and small, driving innovation, tough decisions, and a new era of competition in the American economy. While tariff news rattled markets, new inflation data brought relief. The August PCE price index, used by the Fed to track inflation, rose just 0.2% for the month, steady at 2.9% annually. That's higher than the Fed's 2% target, but not spiraling out of control. Stable inflation means paychecks go further, and planning is easier for families and businesses. But this data doesn't reflect the impact of the latest tariffs, which could push prices higher in coming months. For now, investors are reassured, but the calm may be temporary. The real test will come as new trade policies filter through to consumer prices. The next few months will reveal if this stability can last. With tariffs and inflation dominating headlines, all eyes are on the Federal Reserve and what it means for your money. The Fed's decisions ripple through the entire economy, affecting everything from the cost of groceries to the value of your savings. The Federal Reserve sets interest rates, which play a crucial role in shaping the financial landscape. Whether you're applying for a mortgage, carrying a balance on your credit card, or considering a car loan, the Fed's choices directly impact how much you pay in interest. Vice Chair Michelle Bowman is advocating for rate cuts, pointing to a job market that's showing signs of strain. She believes that lowering rates could help support workers and businesses, especially if economic growth slows due to new tariffs. Bowman argues that with global trade tensions rising, lower rates could cushion the blow for American workers and keep the economy moving forward, even as some industries face uncertainty. On the other hand, Fed Chair Jerome Powell is urging caution. He's focused on balancing the risks. Moving too quickly could reignite inflation, while waiting too long might hurt job growth and consumer confidence. The Federal Reserve is divided. Some officials want to act now to protect jobs, while others prefer to wait and see, worried about the possibility of rising prices if they cut rates too soon. For now, the central bank is holding steady, carefully monitoring every new data point. They're watching employment numbers, inflation trends, and global developments to decide their next move. The Fed's future actions will depend on whether the job market shows more weakness or if tariffs start to push prices higher for everyday goods. Whatever the decision, the Fed's moves will shape borrowing costs, investment returns, and the overall momentum of the U.S. economy in the coming months. Investors, business owners, and everyday consumers are all waiting for the Fed's next signal, knowing it could affect everything from stock prices to the cost of living. The stakes for your wallet have rarely been higher, making the Federal Reserve's next move one of the most closely watched events in the financial world. Amid the tariff turmoil, tech stocks got a boost from a new White House proposal. The plan requires U.S. tech firms to match every imported semiconductor chip with one made in America, or face tariffs. This rewards companies like Intel and GlobalFoundries, who've invested billions in U.S. factories. Intel's stock jumped 4%, GlobalFoundries soared 8% on the news. The policy aims to strengthen domestic chip production and reduce reliance on foreign suppliers. It's another America First move, echoing the push to bring drug manufacturing home. For U.S. chip makers, it's a potential game changer and a big advantage over overseas rivals. The global semiconductor landscape could shift dramatically if this rule becomes law. Investors are betting on a new era for American tech. Despite headline-grabbing volatility, the U.S. economy's foundation looks solid. Revised GDP data for Q2 showed stronger growth than first reported. Businesses produced more, consumers spent more. This resilience helps explain why markets rebounded quickly after tariff shocks. A strong economy can absorb some trade turbulence, at least for now, but GDP is backward-looking. It doesn't show the impact of the latest tariffs. The real question: can this strength continue as trade pressures mount? Investors are watching to see if growth holds up in the second half of the year. The next few quarters will reveal whether the economy can stay on track. For now, the fundamentals are better than many expected. The market's mood is a tug-of-war between fear and opportunity. Tariffs spark anxiety, higher costs, uncertain outcomes, and the risk of a slowdown. But optimism persists, fueled by stable inflation, strong GDP, and tech sector gains. Last week's rebound was a win for the optimists, but caution remains. Mixed signals make it easy for investors to get whiplash or make emotional decisions. The key: don't get lost in daily headlines. Smart investors are staying calm, watching how tariffs, inflation, and Fed policy play out. The current environment demands patience and careful assessment. The market is neither panicking nor euphoric. It's waiting for clarity. Navigating this uncertainty is the challenge and the opportunity of the moment. So what does all this mean for you? New tariffs will likely make goods like furniture, trucks, and medicines more expensive. If you're investing for retirement, the recent volatility is a reminder to stay calm and stick to your plan. Don't let fear drive you to sell at the worst moment. Last week's rebound shows how quickly things can turn. Diversifying your investments can help cushion the impact if one sector gets hit. The strong economy and tech sector gains show there are still opportunities, even amid uncertainty. Review your financial goals, stay informed, and avoid knee-jerk reactions to headlines. The story is still unfolding, and patience is your best asset. The right strategy now: stay steady, stay diversified, and keep your eyes on the long term. Your financial future depends on smart, measured decisions, especially in times like these.